All right, today we're diving into a stock that has been on an absolute tear, Western Digital, ticker WDC. We're going to break down its incredible surge and then walk through a really interesting, high-probability option strategy from our source material that's designed to play this exact situation. So here's how we're going to tackle this. First, we'll get a handle on WDC's amazing run-up. Then, we'll dig into the charts and see what the technical signals are telling us. After that, we'll unpack the strategy itself, get into the nitty-gritty of the trade, and finally, look at the two simple ways it can all play out.
Okay, first things first, let's set the stage. Western Digital hasn't just been doing well, it's been on a truly meteoric rise, pushing its stock price into completely new territory.
Now, according to the source material, this massive surge is really being fueled by the AI boom and the crazy demand for data storage. The result? A gain of nearly 100% just since the start of the year. I mean, that's just a huge, huge move in a short amount of time, and it really creates a fascinating setup for our analysis. This all came to a head when the stock closed at a brand new all-time high of $404. Now, whenever a stock does this, traders call it price discovery mode. And what that really means is there are no old ceilings or resistance levels to stop it. It's blue sky territory. And of course, this kind of performance creates that classic dilemma, right? You see this rocket ship taking off, but you're probably thinking, am I too late? Am I about to buy at the absolute top? And that's exactly where turning to the technical data becomes so crucial. So let's do just that. Let's move on and break down what the charts are actually telling us based on the source's analysis.
Okay, this is where it gets really interesting because the data is kind of telling two different stories at once. You've got the MACD, which is all about momentum, and it's flashing a strong buy signal. But then you have the RSI, which measures if a stock is overbought, and it's basically waving a little yellow flag. And holding it all together is this really strong support level, which acts like a potential safety net below the current price.
So here's the bottom line. The MACD is telling us, hey, the upward momentum is legit and it's powerful. But that high RSI number, it's whispering, careful, this thing might be a little overheated and could pull back for a breather. This is what makes that support level down around 335 so important. It's the price where in the past, buyers have shown up in force.
So you've got this push and pull, right? Strong momentum, but also high risk. How do you play that? Well, the source material proposes a specific option strategy that's tailor-made to generate income while managing that exact pullback risk. The strategy is called a cash-secured put. And honestly, the easiest way to think about it is this. You get paid cash today for simply agreeing to buy a stock you already like, but only if it drops to a much lower price that you get to choose. It's almost like getting paid to put in a lowball offer on a house.
And this really shows you the simple beauty of it. You pick your stock, you pick your discounted price, you sell the put option, and you collect cash immediately. After that, it's a two-way street. Either the stock stays high and you just keep the cash, no strings attached, or it drops and you get to buy that stock you wanted at the bargain price you set from the start.
All right, enough with the theory. Let's get practical and apply this directly to WDC. Let's look at the exact trade that's being recommended in the source material.
Here are the numbers. The idea is to sell a cash-secured put with a strike price of $335 expiring on May 1st. By selling this one contract, you'd collect $300 in cash premium right away. And notice that strike price, $335. Sound familiar? That's not a random number.
Yeah, choosing that 335 strike is a completely strategic move. For one, it's about 17% below where the stock is trading right now, which is a massive cushion. But even more importantly, it lands smack dab on that strong technical support zone we just talked about. I mean, for the stock to fall that much in just 5 days, something pretty significant would have to happen.
And this leads us to the odds. Based on all the data, there's about a 90% theoretical chance that WDC will stay above that 335 price by the time the option expires. That incredibly high probability of success is exactly what makes this a more conservative, income-focused approach.
So what about the return on your money? Well, you collect that $300 premium by setting aside $33,500 as collateral. That works out to a 0.9% return on your capital. Now, that might not sound huge, but remember, that's for just a 5-day trade. If you could do that consistently, it adds up to a really attractive return over a year.
So the trade is on, the clock is ticking. What happens when we get to that May 1st expiration date? It's actually super simple. There are only two ways this can end.
And this lays it out perfectly. Let's talk outcome A, the 90% probability scenario. WDC closes anywhere above 335, The option just expires worthless, you keep that $300 as pure profit, and you move on. Simple. But what if outcome B happens? If the stock does drop, you honor your agreement and you buy 100 shares. But here's the key. Your actual cost isn't $335. It's $327, because you subtract that $3 premium you already got paid.
And even if you do get the stock, the plan doesn't just stop there. The source points out that the very next step is to start selling what are called covered calls against your new shares to bring in even more income. This is actually a whole other popular strategy known as the wheel. So here's the real takeaway. This strategy gives you two powerful and frankly two pretty desirable ways to interact with a high-flying stock. You either get to generate some quick income from it, or you get the opportunity to buy a great company at a deep discount, right at a place where the charts say it's a smart price to buy. It's just a fantastic, defined risk approach. Hey, thank you so much for watching this explainer. If you found this breakdown valuable, please give this video a like and subscribe for more deep dives.